Hello, everyone, and welcome to Experian's 2022 Women in Business Credit Study. My name is Gary Stockton. Before we get started, I'd like to cover a few housekeeping items. If you would like to follow along, we have dropped a PDF of the slides in the handouts area. We'll also include a link to the slides in a follow-up email. During today's webinar, we'll be sharing insights from our most recent study of women business owners. And your presenter today is Emily Garrett. Emily is an analytical consulting manager working in Experian's Commercial Data Sciences Group. She manages the small business Ascend analytic consulting team, and this work involves bringing new innovations and insights to market for small business lenders and insurers. Emily graduated with an MBA from Carnegie Mellon University Tepper School of Business with a concentration in quantitative analysis. Now, if any questions come to mind during this talk, we encourage you to submit them using the question answer box located in your webinar applet, and we'll route them on our end and send you our responses. And now I'd like to turn things over to Emily Garrett. Emily.
Thanks, Gary. Good morning. I am very excited to present this year's Experian Women in Business survey. This is something that I am very passionate about myself, and also that Experian has been putting a lot of focus and effort into in order to help expand access to lending for women and minority business owners. We see that about 34% of new business starts are by women. This has been pretty consistent over the last several years. So if you look back at the last couple of women in business surveys we've done, it's about a third over time. This is despite efforts to try to increase this accessibility. And we'll see that while there is a lot of area of optimism for the future for women business owners, there's also some challenges that really could be addressed by companies like Experian, as well as by lenders and by business groups that help to educate new business owners. We also see that minority women are even fewer new business starts than non-minority women. So of the 34% of new business starts by women, only about 27% are from minority women. So there's a lot of area of opportunity for growth there as well. Despite the challenges, we see that women business owners are generally optimistic about opportunities post-COVID. In a survey done late last year by Guidant Financial, women business owners reported that generally they have a good amount of confidence in small businesses post-COVID. About 45% were either somewhat or very confident. Looking through the reasons why women open up businesses, they are very positive reasons and really show that opportunity that's out there. So they're ready to be their own boss. They want to pursue their passion. The opportunity presented itself, or even they were laid off, but then found a way that they could take that as an opportunity and start their own businesses. So not surprisingly, about 76% of them report being either somewhat or very happy as business owners. So this is all very good news. There have, however, been real detrimental impacts because of the COVID pandemic. Women-led industries tend to be more in those that were really affected by COVID more than others. For example, health, beauty, and fitness, retail, food and restaurant. Women tend to really be in these industries, and they were ones that, as we know, tended to be shut down, tended to have capacity limitations, and all sorts of other challenges that made it difficult for these businesses to survive and to thrive. And that resulted in some challenges, such as a loss of revenue, having to temporarily close, reducing their budgets, and women business owners having to reduce their own wages. Luckily, with everything that has happened, by the end of last year when the survey was taken, we see that about 77% of those business owners were still expecting to survive, although unfortunately almost a quarter were not or were unsure. Besides COVID, there are other challenges that women-led businesses face, and these have also been consistent over time. This predates COVID. So finding the ability to do enough marketing and advertising. 17% said lack of capital and cash flow. 15% said recruiting and retention of employees. I'm sure that most of you listening to this can relate to that one. I know that I certainly can. It has been a difficult time in general for recruiting and retention of employees, and women business owners are no different. One thing that we might be able to help address, though, are things like the marketing and advertising and the lack of capital and cash flow. So, marketing and advertising challenges could be a cash flow issue because marketing and advertising tend to be expensive, and also an expertise issue. So, this is something where making people available or putting forth programs that could help with marketing for inexperienced business owners might help these businesses be more successful, especially early on when it's really important to get the word out there. We see that women are financing their businesses more personally than through traditional credit avenues. And this is probably part of what's going into that lack of capital and cash flow that they're struggling with. About 72% of them are financing through their own cash, through 401k rollover programs, or through friends and family. You can see moving over to the right that the SBA loans and lines of credit and the other sorts of traditional lending products are really small proportions of what they're using. This is going to limit the amount of cash that they have early on when that investment is so critical to getting off the ground and being successful. In addition to the types of funding that we see that are coming through banks, it looks even worse when we look at venture capital, which we know is also critical for entrepreneurs. So only about 2.3% of venture capital is going to women entrepreneurs. And this disparity is leading to startups that are run by men being about 3.5 times more likely to generate that $1 million in revenue that is seen as a dividing line between your business being launched and having a great chance of success and being not quite there. So trying to fix this disparity is incredibly important. One area that contributes to this, as well as to just the general successful startups of businesses, is that women tend to lack mentorship and support. So only about half of them are getting that mentorship and support that they need. This is something we've long known about in corporations when women have trouble rising up into leadership positions because of a lack of mentorship. We see it also for business owners. It is difficult to start a new business, and having experienced people to guide you is critical to success. So anything that we can do, or you see a growing number of organizations out there that are intended to support women starting businesses that can help in this area, is going to help increase the amount of women-owned businesses and the success rate. Another challenge, of course, as we've talked about, was COVID-19. Women-owned businesses, being primarily in hospitality, wholesale, and retail, were disproportionately affected by the pandemic. And that's something that has been difficult to recover from. And it's not only business challenges themselves. Childcare ends up being a very big and disproportionate challenge for women business owners compared to men business owners. So first, just directly, if women, small business owners, or employees in general don't have access to childcare, they are unable to go to work. And that is going to be a big challenge. In addition, childcare businesses tend to be owned by women. Actually, about 90% of them are owned by women. As one business owner quoted, childcare and workforce development are very linked. We can't just leave it up to parents. And that is both on the side of all working women and working parents generally, and also as business owners. These centers were really left out of the economic aid that was provided to other small businesses. The COVID pandemic was not deemed as a national emergency, like, say, hurricanes and other natural disasters have been. When that happens, the aid can cover all operating expenses. In this case, PPP loans were only covering wages, and that left a lot of women-owned businesses out of the direct benefits of those programs. We should also think about childcare as a business issue and as an economic issue overall. So in a Harvard Business Review survey, 26% of women who became unemployed said it was because of a lack of childcare. We also know that childcare issues hurt women disproportionately. The COVID pandemic, of course, not only closed daycare centers, but also schools. And a lot of those, the household burden fell on mothers. This is going to especially be an issue for minority women and for single mothers. Further studies have shown that this is not only an issue for businesses and for families, but it's also an economic issue. So our GDP could be 5% higher if women were participating in the workforce at the same rate as men are. This is something that has been improving over time, where we see women becoming a greater and greater share of the workforce. And then the COVID pandemic, of course, reversed a lot of that ground that now needs to be made up. It was a bit of a hidden issue up until this pandemic happening, but now it's something that can be addressed by both employers and by government programs. Moving over now into looking at credit and the participation of women within the credit market. Women-led businesses remain over time at about 28 to 29% of new originations. So while they're making up 34% of new business starts, they're a bit proportionally lower in the amount of new originations. If you look at the top graph here, this is just the pure number of new originations, not including PPP loans, over the last several quarters, the last 8 quarters or so. If you look at the green bars, that is the average loan amount that is being given out at the point of origination. So overall, in general, men are getting higher originating credit lines on average than women are. So once again, we're seeing less of that capital availability to women when they're starting off getting funding for their businesses. On the bottom graph, you can see the proportion of those new loans. And so that's where we're seeing about 28 to 29% of new originations going to women. Women-led businesses also took out fewer PPP loans. Some of this may have been because they didn't qualify for reasons we talked about before, the limited use cases for being able to qualify for PPP loans and for the repayment forgiveness. Some of it could be a lack of education about what was required, or a lack of access to the lending market generally. Another consistent thing that we've seen over time is that while looking at the bottom, you can see that women-led businesses have about the same distribution when we look at number of employees as their male counterparts. But looking at the top graph, their companies are bringing in less revenue annually than their peers. So you can see we're skewed a bit more toward the smaller revenue amounts for women-led businesses versus their male counterparts. And as we go into larger and larger businesses, men start to take up a bigger share. The top 5 industries, interestingly, from our data for men and for women are the same. So professional services, retail trade, other services, healthcare, and construction. But the way that they're ordered and the proportions are very different in a way that matters quite a bit. So for women, we have professional services at the top, and for men the same. So that's about equal. But the second most common industry for women is retail trade. And of course, we know retail trade was very affected by the pandemic and also tends to be a lower margin sort of industry. For men, that second group was construction, and it was a higher proportion than you're seeing for women in retail trade even. Construction, unlike retail and healthcare services and restaurants and bars and places like that, it actually benefited from the pandemic in a few ways. Primarily that people, when they started staying home and they weren't paying to commute and they weren't paying to travel, and they had a lot of expendable income all of a sudden. And so they started doing home improvement projects. So we've heard a lot about this, and this really benefited those who were in the construction trade, which overwhelmingly tends to be male-owned businesses over women. Moving down the list, healthcare and social assistance, you can see how that is also something that was really affected by the pandemic and tended to hurt women more than men. Now, looking more at just overall risk and how that plays out in the credit market, women have lower business risk scores, meaning that according to business risk scores, they look like they're higher risk than men. On Vantage Score, so looking at the consumer instead of the business, they're about equal. However, women have lower other risk indicators, such as having fewer average inquiries. One of the parameters that goes into risk scores, of course, is seeking out new credit, and women tend to seek out new credit less than their male counterparts. In addition, they also tend to have fewer average bankruptcies. So by this measure, it looks like they're actually a pretty good risk. The outcomes, however, are that they end up with an average number of new trades that's below men. They have fewer open trades at any given time, and their balances and loan and line amounts are lower as well. So this really contributes into this ongoing story that these businesses are resource constrained and could really benefit from having a higher access to capital and investment so that they can be successful. Throughout the presentation today, we've seen a lot of areas of challenge, some reasons for optimism, and of course, areas of opportunity to help women business owners be successful, start more businesses, and grow over time. Some of those are from the government. So we talked about the way that you look at a disaster and the way that those relief funds can really affect businesses based on how they're using, where they really need the help. So that's an area that they could do better. Anything they could do around childcare to make that more available, having just a complete collapse of the childcare system, whether through direct childcare or schools, public schools, obviously was a big problem that could be addressed before this happens again in the future. The financial industry, so we have seen here at Experian a lot of interest from the financial industry in coming up with programs that specifically increase accessibility for women and minority business owners. I really think that over time, this is something that is going to improve because there's all this awareness and attention on it. There's a desire to really do better. One thing that they can do is to check and make sure that their origination policies and their scorecards are truly neutral. So if you have lower risk indicators, you should have a better risk score, for example. And this is something that using various DE&I measures on business owners, you can check and see how you're doing. Are you declining more of certain types of business owners, for example? And Experian is doing a lot and can continue to do more. We have business ambassador programs where we address women and minority business owner groups. There are a lot of nonprofit groups out there now really focused on helping women and minorities start businesses and be successful. And that's something we can help with. We have partnerships with CDFIs. We have credit education programs. Sometimes getting access to credit, whether that's on the consumer side or on the business side, has to do with understanding how you're evaluated. How does a lender see you when they're deciding whether or not to give you a loan and how much they should lend to you? We're also doing a lot of work in finding data other than credit data to help lenders make decisions. One area of opportunity that we are focusing quite a bit on is looking at deposit data. So user permissioned data where a lender can go in, see the cash flow through a checking account, and determine whether or not a business can pay back a loan without having to see previous credit activity. Getting established with credit can be one of the most challenging things for new businesses. And if we can look at other ways of making a decision besides relying on previous credit activity, setting up a bit of a chicken and egg scenario, then we can get more lending out to those businesses who need it in the beginning. I want to thank everyone for watching this report today. I really enjoyed putting this together and delivering this report. And if there are any questions, I look forward to answering them at a later time. Thank you.
Well, with a significant surge in new business starts, many of them women-owned and led, lenders are looking for innovative ways to assess small businesses with low or no business credit scores. And that's where Experian DataShare comes in. With DataShare, your customers will experience a touchless digital journey that eliminates friction points that some may feel are intimidating or exclusionary. It enables small businesses to include owner-permissioned financial statement data during the loan application process. This helps lenders to better assess the cash flow situation of the small business loan applicant, particularly emerging businesses with excellent cash flow. And this expanded data can be used in the decision-making process in addition to bureau data to create more approvals. If you would like to learn more about how Experian is helping financial institutions to offer financing to emerging small businesses, go to experian.com/datashare. With that, Emily and I would like to thank you for watching today's webinar. Look for a follow-up email from Experian with additional information. Good day, everyone.